Bitcoin has become a popular mainstream investment, but it's also known for its volatility.
You don't know if in a week's time the value will be 20% lower, 10% lower, 10% higher.
Its value fluctuates so much that few people would use it to buy everyday goods such as shampoo or a plane ticket. Some crypto entrepreneurs say there's one way to change that: stablecoins.
Dai, this is a really interesting one.
USD coin or USDC.
Stablecoins are different from other cryptocurrencies in that they are pegged to assets like the US dollar or gold, which is meant to make them more stable. They've grown particularly popular among traders online. In just a year, as Bitcoin hit new records, the market value of stablecoins has grown tenfold. Facebook has announced plans to launch its own stablecoin, and Visa said it would create a stablecoin credit card. But a probe of one stablecoin exposed some potential risks with this system.
It's Tether.
The New York Attorney General had accused Tether, the most popular stablecoin, of lying about the cash reserves it uses to guarantee its dollar peg. Tether did not deny nor admit wrongdoing as part of a 2019 settlement, but agreed to release quarterly statements detailing its reserves. So can stablecoins accelerate the adoption of cryptocurrencies in our daily lives, and will they change the way we pay for goods? According to its creators, Bitcoin was meant to allow direct payments without ever going through banks, but so far it's been accepted by few companies, with very few high-profile exceptions like Tesla. Market analysts found that Bitcoin's price has at times jumped or crashed by as much as $6,000 in a day, but that hasn't been the case for stablecoins. In the past year, the value of top stablecoins has fluctuated by as much as 4 cents to their $1 pegs.
You can have reasonable assurance that in 3 months' time or 6 months' time or 1 week's time, it'll still be worth $100. And that's what was missing in crypto before stablecoins came along.
Alex Kern is an analyst who researches stablecoins and other cryptocurrencies. He says the first stablecoins were created as early as 2014.
The 24-hour trading volume is often over 90 billion. Bitcoin is a little over 50 billion. So it trades more often than Bitcoin.
Tether was pegged to the US dollar, and more than 200 other stablecoins followed. Some pegged to the euro or to the Korean won, others to commodities like gold, silver, or oil, or a combination of different assets. On top of stability, stablecoins like Tether have another key advantage: speed. Because this is digital money, transactions go through in a matter of seconds, faster than the 3 days it usually takes to wire US dollars or euros using traditional banks. Stablecoins are also faster than Bitcoin because the payments are centralized and managed by the company that created them. For example, Tether transactions are managed by the Tether platform, while Bitcoin payments are processed by a vast decentralized network of people called miners who are spread out all over the world.
It's instantaneous. There's no settlement process that needs to occur.
Only a handful of e-commerce websites accept stablecoins at the moment. But crypto traders have quickly adopted stablecoins like Tether to buy and sell cryptocurrencies online. That's because stablecoins don't run on normal banking hours. Compared to stocks that have to be traded in locations like New York or Hong Kong during specific hours, cryptocurrencies are traded 24 hours a day, 7 days a week, all across the globe. Plus, academics who study the role of cryptocurrencies say some banks have been wary to interact with crypto exchanges due to the lack of oversight in the industry and concerns that they could be exposed to illicit activities like laundering money or funding terrorism. Binance, one of the largest cryptocurrency exchanges in the world, said it is committed to creating a compliant, safe, and reliable trading environment, and it asks users to follow all local laws on money laundering and counterterrorism financing. In 2019, the New York Attorney General accused the companies managing the stablecoin Tether, also called USDT, of making false statements to investors about the cash reserves of its currency, an essential component of what makes it stable and secure for investors. The crypto community online discussed the probe and Tether's dollar backing.
If you go to their website right here, it says every Tether is always 100% backed by our reserves.
The investigation found that in 2017 and 2018, Bitfinex, a cryptocurrency exchange that has common ownership with the company that controls Tether, relied on a third-party company named Crypto Capital Corporation to handle deposits and withdrawals on Bitfinex's trading platform. The New York Attorney General's office said that Crypto Capital Corporation failed to process some of these orders, and Bitfinex lost access to $850 million of its customers' money. Crypto Capital said it couldn't process Bitfinex transactions because in 2018, its bank accounts in the US, Poland, Portugal, and the United Kingdom were frozen without justification.
Naturally, this significantly delayed fiat withdrawals from Bitfinex for its users, which started to suspect something was up.
The New York Attorney General's office said Bitfinex tapped into Tether's dollar reserves to cover up the losses and afterwards lied to its customers when it said its currency was fully backed by US dollars at all times. During the course of the New York Attorney General's investigation, Tether said it held 74% of the necessary reserves, which some investors considered to be enough to make the digital currency secure. As part of a settlement with the New York Attorney General's office, Bitfinex and Tether Limited paid $18.5 million in penalties and stopped trading activity with New Yorkers.
This is finally coming to an end.
Bitfinex and Tether said the amount of money they agreed to pay should be viewed as a measure of their desire to put the matter behind them. The firms did not admit or deny any wrongdoing. Industry insiders say this investigation should be a warning to all companies that created stablecoins and to expect the stablecoin industry to be more tightly regulated in the coming years. Some companies are already looking towards a future of using reliable virtual money as payments. Visa announced a stablecoin-based credit card and said that making its digital currency strategy secure, private, and trusted is a key priority. Facebook's new cryptocurrency project, Diem, aims to create stablecoins pegged to different fiat currencies. Diem says the system is being built with security in mind. Some countries are also working on what financial analysts call the next iteration of stablecoins, which would be a digital currency pegged to the national currency and controlled by central banks. But before this type of digital money truly goes mainstream, Kern says its creators and issuers are going to have to convince regulators and users that their technology will keep their money safe.
It's going to be very important for people to trust the entity that's issuing the stablecoin. And the one that has the most trust of people over a period of time will be the one that becomes the most heavily used.
In essence, stablecoins are cryptocurrencies whose value are pegged to an existing asset, most often the US dollar, though there are others tied to the euro and gold too. They're sort of like casino chips for the crypto world. Traders buy tokens like Tether or USD coin with real dollars. Those tokens can then be used to trade bitcoins and other cryptocurrencies. And whenever someone wants to cash in, they can get the equivalent amount of dollars for however many stablecoins they want to redeem. Glenn Goodman is a former financial journalist turned crypto investor. He ran me through the importance of stablecoins to the crypto market.
For any financial market to be efficient, it needs to be liquid, there needs to be a lot of trading going on, it needs to be functioning smoothly. The problem is that transferring from fiat currencies like dollars into cryptos is actually a hassle, it costs money, it takes time. Stablecoins solve that problem by allowing you to transfer an amount of fiat currency into an equivalent number of tokens, and then those tokens can quickly and cheaply be traded in and out on the exchanges. It makes a world of difference.
But as it turns out, some stablecoins aren't quite as stable as they're made out to be.
We saw UST, one of the most popular US dollar peg stablecoin projects, totally collapse.
And consumers have gotten hurt real bad this time, and that's a problem for the whole industry.
It was very much marketed as a stablecoin, but Terra USD, otherwise known as UST, didn't hold up to its promise. Instead of fiat currency reserves, UST relied on a complex set of rules. If the price of UST sank below $1, an algorithm would kick in, creating new units of a sister coin called Luna, while taking an equivalent amount of UST out of circulation. The idea was that this would throttle the supply of the stablecoin and push its price back up to $1.
Stablecoins are in two different types. The most easy to understand of those are the ones that are simply backed by, say, dollars. So you have an equivalent amount of dollars in a bank account somewhere, or things that are almost the same as dollars, like treasury bills. The other type are the algorithmic stablecoins. What they tried to do was get around the problem of needing tons of collateral, loads of dollars in a bank. As pressure is put downwards on UST, through the mechanisms that work to try and stabilize it, actually the price of Luna is kind of forced slowly downwards. And whilst most of the time that system actually kind of works okay and it stabilizes the currency, in an extreme situation like this one, what happens is it becomes a vicious circle where UST has got pressure on its peg, it's becoming worth less than $1, the price of Luna falls further, and in the efforts to try and shore up UST, the price of Luna falls even further, which scares the hell out of people and makes them start selling like crazy.
After UST broke the buck, Tether also temporarily fell below $1 on numerous exchanges. Tether, the world's biggest stablecoin by market value, has long faced doubts over whether it holds enough assets to support its purported peg to the dollar. Tether processed more than $10 billion in withdrawals in May as investors got cold feet about the token. The source of Tether's reserves has been under scrutiny after a series of disclosures showed it wasn't always backed one-to-one by cash as initially claimed. For its part, Tether says it is increasing its holdings of US Treasury bills, which are viewed as safe and easily convertible to cash, while at the same time reducing the amount of commercial paper it's sitting on. Some of Tether's critics also worry it has been used to manipulate crypto prices, a claim the company denies. The UST debacle has put regulators on edge. Governments in the US, UK and EU want new rules aimed at taming stablecoins, a market that was worth over $150 billion in the middle of 2022. While most economists agree stablecoins aren't yet big enough to pose a systemic risk, they're concerned that could eventually be the case if stablecoins are left to grow to a point where they become too big to fail, similar to what happened with the 2008 financial crisis.
This gives me nightmares because it takes me back to when the Lehman Brothers collapsed in 2008. And everybody was saying the same thing at the time. The financial world is so complex that nobody quite understood all these financial instruments and how they interacted with each other. So nobody knew that there was trouble on the horizon because it was too much for any one human brain to understand. Similarly, with Terra Luna, the complexity just kind of bamboozled everybody.
A rapidly growing financial trend is attempting to turn traditional banking on its head. It's called Decentralized Finance, or DeFi, and it promises to bring digital banking for cryptocurrencies to the masses, but with no middlemen and almost no barriers to entry. Estimates vary, but a conservative one says the total value locked in DeFi reached $114 billion in November this year. And while that's just a fraction compared with traditional banking, DeFi is growing quickly. It has increased more than 1,200% since June 2020. Here's why some are calling DeFi the Wild West of finance, where investors are entering uncharted territory to take on big risks for the chance of even bigger rewards.
DeFi is just the next iteration of this grand experiment in cryptocurrencies, which is basically just to recreate the financial system in a digital online format.
Paul Vigna has been reporting on the equities market for almost 25 years and has been covering cryptocurrencies since 2013.
Anything you could do at a bank or at a brokerage is handled, rather than through an individual and a corporation, it's handled through a computer program.
You can think of the emergence of DeFi like this: a dusty town in the wild American West, where there's no sheriff, no bank, and no cash. Here at the local trading post, people can trade and lend goods, and do pretty much anything else normally done at a bank. It isn't owned by a single person or entity, and unlike traditional finance, trades that happen here are verified out in the open, where everyone can see. For example, one type of transaction that takes place at the trading post is lending. To ensure the trade, the borrower gives collateral for the loan. The lender then earns interest off this deal in the same way a bank would. Transactions like this are all recorded on a public ledger that everyone can see. In the world of DeFi, this ledger is called a blockchain, which is a network of computers built to store and record transactions.
Every computer on that network has an identical copy of that ledger, so that all of the data is open, all of it is public.
This is different from a traditional stock trade, which works like this.
I have a broker, the other party has a broker, the company has an institution that keeps track of the stock itself. all these different middlemen, all these different intermediaries have their own ledgers, have their own internal databases where they're recording the transactions. A blockchain takes care of all of that and does it in an open way that anybody can track the progress of that trade.
Most DeFi services run on Ethereum's technology, which also hosts the cryptocurrency Ether. It's one of the most commonly traded cryptos in DeFi, along with stablecoins, digital assets which are pegged to currencies like the dollar. The DeFi services run on the blockchain, similar to how apps run on your phone. And the mechanism that allows them to work is called a smart contract.
Smart contracts as an idea have been around for years. It's another app that is focused on a bank-like service. So all it's really doing is taking all the parameters of a trade and sticking them into fields and automating it, and then monitoring it.
Smart contracts are designed to give DeFi transactions more transparency and security.
And because all the parameters are being inputted into a program, ostensibly it's more secure because there shouldn't be any real debate or contradiction about the terms of the service.
Despite this layer of security, decentralized finance carries a lot of risk. In many cases, the people facilitating DeFi transactions are anonymous. This has caused fraud to become rampant. A poorly created smart contract could have loopholes that allow scammers to steal, or other design flaws that affect the value of assets. Another risk is security. And because most DeFi services aren't insured, if a platform fails or is hacked, millions of dollars can be on the line.
The problem is that you may not know who wrote the program. You may not know how secure the program itself is. That's a significant risk that you really can't overlook. These DeFi protocols, virtually once a week, there is a problem with one of them.
So far this year, investors have lost about $1.5 billion to DeFi attacks, hacks, and cons. And in this wild west of finance, regulation is still virtually non-existent. Though that could change. Here's the chairman of the Securities and Exchange Commission speaking with the Wall Street Journal about DeFi.
But if this field is going to have an ability to move forward, it's going to be inside some public policy framework and inside some sort of regulatory perimeter. Look, folks have already been hurt in this field.
While decentralized finance is risky, many think the potential benefits are worth it.
Benefits are an ability to make money. You are either lending out your cryptocurrencies and you're getting interest paid back on that, and that interest can be anywhere from 5 to 20%, even more. You can be a passive investor and earn money on an asset that you were probably storing in a wallet that was doing nothing. The other benefit is you can borrow against your holdings. A lot of these services are being used as a way for people to get a bigger pool of cryptocurrency to go throw bets out into the derivatives market. So it's a way for you to turbocharge your cryptocurrency gambling habit, essentially.
If DeFi continues growing, it's likely that regulations will be imposed to smooth out its rough edges and reduce risk for investors. Which makes sense. Even in the wildest of Wild West towns, a sheriff eventually showed up to lay down the law.